Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Cogent Biosciences Inc. Annual Report. Cogent Biosciences Inc. is a biotechnology company that specializes in developing precision therapies for genetically defined diseases. The company's lead product candidates include two innovative treatments: bezuclastinib CGT9486 and CGT4859. Bezuclastinib is a selective tyrosine kinase inhibitor currently in Phase 3 trial, designed to target specific mutations within the KIT receptor tyrosine kinase. This includes the KIT D816V mutation that drives systemic mastocytosis, as well as other mutations in KIT exon 17 found in patients with advanced gastrointestinal stromal tumors. CGT4859 is a reversible and selective fibroblast growth factor receptor 2 inhibitor in Phase 1 trial for patients with documented FGFR mutations. This includes advanced cholangiocarcinoma, a type of cancer that affects the bile ducts. In addition to its product development efforts, Cogent Biosciences has also established a licensing agreement with Plexicon Inc. for the research, development, and commercialization of bezuclastinib. The stock price of Cogent Biosciences Inc. (COGT) has skyrocketed by over 365.59% in the past year due to a series of positive news events surrounding its lead drug candidate, bezuclastinib. The company's fortunes began to change with the announcement of successful clinical trial outcomes for bezuclastinib in various indications. One of the key drivers behind the stock price surge was the positive top-line results from the SUMMIT trial in non-advanced systemic mastocytosis, non-ADV-SM. This was followed by equally impressive results from the PEAK Phase 3 trial in gastrointestinal stromal tumors, GIST, which demonstrated a significant improvement in progression-free survival. The company's financial position also received a boost with the completion of concurrent public offerings, raising approximately $546.8 million in net proceeds. The string of positive developments continued with the announcement of top-line results from the APEX trial in advanced systemic mastocytosis, ADV-SM, and the submission of a new drug application, NDA, for bezuclastinib in non-ADV-SM. The FDA also granted breakthrough therapy designation for bezuclastinib in GIST, further solidifying its position as a promising treatment option. The initiation of NDA submission for bezuclastinib in GIST under the Real-Time Oncology Review (RTOR) program marked another significant milestone for Cogent Biosciences. These consecutive positive developments have been the primary drivers behind the significant increase in COGT stock price over the past year, as investors become increasingly optimistic about the company's prospects. Cogent Biosciences, Inc. maintains a market capitalization of $6 billion, broadly in line with the industry peer group. Cogent Biosciences, Inc. trades at a higher price-to-book ratio of 27.05 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 22% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline in a company's financial performance can be identified through various factors. On the growth side, regulatory approval and commercial launch of new products such as bezuclastinib play a significant role. The success of clinical programs and achievement of milestones also contribute to revenue growth. Additionally, tiered royalties on annual net sales of products, sublicense revenue, and clinical and regulatory milestones provide a boost to revenue. On the other hand, failure to complete clinical testing and NDA submission to FDA, rejection or delay of NDA approval by FDA, and net loss can lead to revenue decline. The increase in accounts payable and accrued expenses also contributes to a decline in operating cash flow. Market acceptance by physicians, patients, third-party payers, and others in the medical community is crucial for product success, as well as availability of coverage and adequate reimbursement from third-party payers. In summary, regulatory approval, clinical program success, tiered royalties, sublicense revenue, and market acceptance are key drivers of revenue growth. Conversely, failure to complete clinical testing, NDA rejection or delay, net loss, and increase in accounts payable contribute to revenue decline. The net income of the company has been consistently in the red since its inception, with no change reported until recently. In 2025, the net loss increased from $255.9 million to $328.9 million. This significant jump can be attributed to various factors, including increased expenses and capital requirements due to ongoing activities. Profit margins have also taken a hit, decreasing due to substantial cash consumption since inception. The company's continued spending on commercialization and R&D has put pressure on its financials. Furthermore, the anticipation of significant additional funding requirements and potential risks such as dilution, restricted operations, or relinquishing rights to technologies or product candidates have all contributed to this decline. The uncertainty associated with pharmaceutical product development is a major concern for the company. The expectation of significant expenses related to developing internal commercialization capability has also weighed heavily on its financials. As a result, the net income and profit margins continue to suffer, indicating a challenging road ahead for the company. The company's debt level has undergone significant changes over the past year. Initially, it appears that the debt level increased substantially from $71,612 in 2024 to $301,236 in 2025, page 84. However, another report indicates a slightly different figure, with an increase from $98,165 in 2024 to $312,428 in 2025, page 87. The most recent update as of December 31, 2025, shows a principal amount of $230,000 and a net debt of $222,895. This inconsistency suggests that the company's debt level is not as straightforward as it seems. In terms of interest expenses, there has been a notable increase from $0 in 2024 to $3,062 in 2025, page 73. The introduction of new convertible senior notes with an interest rate of 1.625% per year in November 2025 is likely the cause of this change. Furthermore, another report confirms that the interest expense increased significantly from $0 in 2024 to $3,062 in 2025, page 85. The most recent update indicates a substantial increase in interest expenses from $0 in 2024 to $3.1 million in 2025, page 110. The accumulated deficit has also seen an increase over the past year, rising from $1,141.5 million, implied for 2024, to $1,188.4 million as of December 31, 2025, page 70. This suggests that the company's financial situation is becoming increasingly challenging. The performance of various segments and regions in the market can be analyzed based on available data. The United States emerged as a strong performer, showcasing significant growth and success. Additionally, select international markets also demonstrated impressive results, although specific countries were not mentioned. These positive outcomes suggest that the company's strategies and products resonated well with consumers in these areas. However, it is essential to note that there is no information available on which segments or regions underperformed, indicating a lack of data or analysis on these aspects. Management is optimistic about the company's outlook, citing a significant commercial opportunity with bezuclastinib, estimated to be worth over $4 billion globally. The key objectives for 2026 include obtaining regulatory approval in the U.S. and launching bezuclastinib commercially in the second half of the year. To support this launch, an internal commercial organization will be developed. Management is also pursuing several strategies to drive growth, including developing bezuclastinib in combination with sunitinib as a potential second-line treatment for GIST, and advancing multiple programs, including CGT4255 ERB-BEATWO. The company plans to submit an IND for its KRAS inhibitor program in 2026. Financially, management expects cash to be sufficient to fund operating expenses and capital expenditure requirements into 2028. However, expenses are expected to increase due to ongoing activities, including regulatory approvals, clinical trial results, and market acceptance. Management also acknowledges several risks and uncertainties, including the uncertainty of regulatory approval for bezuclastinib and potential disputes over intellectual property. Overall, management is confident in the company's strategy and outlook, but is also aware of the challenges that lie ahead. The company has a history of not paying cash dividends to its common shareholders. According to the provided information, no cash dividends have been paid out to common stockholders, as per pages 65 and 79. However, there is an exception for preferred stockholders, specifically Series A and Series B preferred stockholders, who are entitled to receive dividends, as stated on pages 95 and 96 respectively. In terms of share buybacks, the company has not provided any information on this matter, indicating that no share buyback activities have been reported. There are concerns about inventory buildup and supply chain disruption. The latter is more pronounced, with several potential risks identified. One major concern is the reliance on sole source suppliers for API and drug product used in bezuclastinib, which could lead to supply chain disruptions if these suppliers fail or are unable to meet demand. Additionally, there are potential risks associated with relying on third-party vendors and contractors, as well as system failures and cyber attacks that could impact operations and business strategy. Furthermore, uncertainty about the ability to meet demand from current suppliers and inability to obtain API and drug product from alternate sources at acceptable prices in a timely manner also pose significant challenges. These concerns highlight the need for careful management of supply chains and inventory levels to mitigate potential risks and ensure continuity of operations. That concludes the financial summary for Cogent Biosciences Inc. Feel free to comment below, and I will be happy to answer them when possible.